say a little better. 1 second, just running around now. It's a little better. Hope everyone's doing well. Good morning, everyone. Today we got a few things to talk about. Don't mind the background. Got some plans. Got some light. But let's see. There's a few things, right? I don't want to talk too much about Liz Truss resigning after about a month, a bit over a month as a UK Prime Minister. We saw some downside pushing from that, right? What happened? I'll talk about it a little bit, right? Truss saw her leadership floundered after an introduction of her mini budget that called for big spending to help the surge of cost of living, while at the same time proposing a number of big tax cuts, along with approaching QT from Bank of England. A budget spurred a liquidity crisis in the UK bond market. So chaos ensued. With the effect of pension funds and mortgage markets forcing the Bank of England to step in and buy long-term debt, and the 30-year gilt yield topped out at 5%, and the pound approached a parity with the greenback, touching about 1.03 cents or $1.03, I should say. So after that, right, we saw in the moment of quantitative tightening in the UK that they had to quantitative ease based on some of those things that we just talked about. And there's going to be a lot of fiscal responsibility. There's been a fiscal lesson learned here for whoever comes after Liz Truss, realistically, that political leaders are no longer able to promise growth by borrowing money without detailing of how they will repay it. So long gone are the days that the government had the support of quantitative easing as the central banks do tighten policy in the face of massive inflation. So in terms of candidates, the latest contest is likely to pit ex-finance chief Rishi Sunak against House of Commons leader Penny Mordaunt. I'm not really sure how to say that. But we could also see a return of Boris Johnson, who was ousted as prime minister in July, was a prior prime minister. So Liz Truss, right? I know a lot of people are exploding all over social media about her 45-day spree. And a result of that was her being eligible for $115,000 pound salary indefinitely for the remainder of her life. So we'll see how that shapes up in the UK. But right now, them and Europe, they're in a sticky situation as inflation is rising pretty aggressively here. I've seen it firsthand. And the economies I think, might falter even before that of the US with this back and forth quantitative easing and tightening, but especially out of the bond market, which I think could be a big catalyst to the next large downside wave and the trigger to this recession that is expected by Bloomberg to be 100% within the next 12 months. Another thing is we talked about social media, how social media has been exploding over Liz Truss's severance package that seems fairly indefinite and fairly unfair. But earnings, right? Social media earnings. We saw social media slip pretty aggressively yesterday, Thursday, after the bell. Snapchat reports as most disappointing revenue growth ever. And the company posted a 6% sales growth as it wrestled with well-documented ad industry recession and its worst quarterly growth number, and a short of 6.4 expectations. So the stock naturally plunged as the announcement pretty much rocked the remainder of the social media world, as well as a lot of tech names, slumping near 27%, bringing the year-to-date losses to over 80% in Snapchat. Along with that, we saw Meta tumble. Google took a little beat down off of that, and this might be somewhat of a prelude as to how those earnings may go. Obviously, Google and Meta are much larger companies, but leading into this with Tesla missing about, we can or might see that next week the earnings from mega cap tech could be worse than expected realistically, right? They've already stalled out. They've stopped the production of a certain iPhone 14, right, with Apple, and we'll see how they shape up, because Apple is going to be one of the main earnings companies that we are going to be watching next week. So a quote from Evan Spiegel, the Snapchat CEO. Our business continues to face significant headwinds this quarter, while recapping that the company has focused on 3 strategic priorities: growing community, deepening engagement, reaccelerating and diversifying revenue growth, and also investing in augmented reality. So when it comes to the overall ad approach, Snap is focused on increasing our share of wallet as growth in the overall digital advertising segment slows. So that will be achieved by working to increase the return on spend generated by its direct response ad platform, as we believe these are the most defensible advertising budgets in the challenged economy environment. So that's what the new COO, Jerry Hunter, also emphasized, that lower funnel objectives to drive more conversions and innovating on our advertising formats in order to make them more engaging. So that's pretty interesting. We'll see how that shapes out. Realistically, it hasn't been working for the past year and a half or so. So Snap did highlight a few positive metrics. That beat on profitability metrics, authorized a $500 million stock buyback, and outpaces expectations for user growth, plus 19% year over year to 363 million daily active users. Realistically, Snapchat, I don't even like. I guess I'm too old for Snapchat, but I don't even know who uses Snapchat anymore. Like, I have a few friends that are even in their early 20s, and even they don't use it. So I feel like they have to be targeting a younger generation. Even the older generation that used to use, well, now my generation that used to use Snapchat, even like millennials, are falling off the cliff. So I guess they're targeting younger audiences. I haven't even seen what Snapchat looks like, but good luck to them. I don't know how that's going to pan out, because you're gonna have to start generating some money out of those ads and out of Snapchat. And I'm not really sure that 13-year-olds are gonna be a target market. So we'll see how that shapes up. Um, the company notably declined to provide any expectations for revenue or EBITDA for Q4, though its expectations to grow seasonality at a pretty good clip. So we'll see how that shapes up, because when they cut, or when they kind of push away expectations or negate to talk about expectations, not necessarily a good sign. Parent company Meta, or Facebook parent Meta, and Google parent Alphabet, right, flag similar problems to Snap when they report next week? Or have they diversified their business enough to shield themselves from the advertising devastation? That's going to be what we see next week. Want to talk about bonds as well, right? Bonds ripping, or sorry, yields ripping, bonds actually dropping pretty aggressively, as we have seen a lot of hawkish chatter. So longer rates are heading even higher this morning, right, with the 10-year up 6 basis points to 4.29 in early trading, and it follows a major milestone in the previous session when the 10-year closed at its highest level since 2008. So the jaws continue to widen between the 2 and 10, and a drop in jobless claims and a more hawkish Fed chatter has been propelling a lot of this, especially the increase in the bond yields and a massive drop in the bond market, which could be one of the main catalysts that sparks this next larger downside move. So treasury prices are now on their longest decline since 1984, when inflation slayer himself, Paul Volcker, was at the helm of the central banking, carrying out rapid rate hikes. Who knows? Maybe Jerome Rival said, maybe let's throw 100 base points in there. Speaking of which, as I talk about these bonds, I do want to load up to see what the FOMC probability is of a rate hike coming up. Um, Someone said, is there a reason for a 40-point pop? I don't know. I haven't really been looking at the market. Maybe the jobless claims that just came out. Honestly, we did see the market rip pretty aggressively. Let me just see. Now I gotta look for this news as I've been talking to you guys. Let's see. I don't know. I think Fed speakers are hitting the wire here. I don't see any news. I think the Fed speakers have been talking. I'm not necessarily sure what they've said though. I'm looking at this. I don't see anything that's worth noting, but it's still a pretty much 100% chance of a 75 base point hike coming out November 2nd. To add to that, with the kind of sidetrack there, to add to the yields commentary, right? On the heels of a fresh move, Fed's funds rate broke new ground, pricing in a terminal rate for 2023 above 5% for the first time this cycle. So bear in mind, on the day of Jerome Powell's hawkish Jackson Hole Symposium, late August, they closed at 3.78% for the March meeting. So the stronger than expected inflation prints over the last couple of months have led to a massive reappraisal in how hawkish the Fed is and other central banks are expected to be. So from nearly 4% to an expected 5% and above, that is a pretty big change that could rock a lot of things, right? As yields continue to increase, bonds continue to drop, and we're seeing mortgages, right? 30-year highest level since 2000, the flip of the millennium, over 7.2% the 30 years in the US. That is insane movement. So there is little in the way of continued treasury selling that would push yields further up, with markets seeing a pain trade of higher rates and a tighter market economic condition. With the effective funds rate now discounted at 5%, there's a path for the US 10-year to get to 4.5% with a 50 basis point through at an extreme in the past when the Fed rates peaks. So I think the 75 bips into the end of the year, right? 275 bips that takes us to 4.5%. And then obviously next year, if they continue to hike, it's going to be much above 5%. So we'll see how that shapes up. Higher yields put sharp pressure on growth stocks and their valuations, like even Meta, 10.4 PE, lowest I've seen at least. Though there was a recent flash of equity resilience earlier in the week, and some strategists are actually calling for a bear market rally. We'll see how that shapes up. Maybe one more time before we flush to the end of the year, but I think the flush to the end of the year is pretty much pricing in right now. So the S&P successfully challenges 200-week moving average at a 50% retracement level around 3,600 to 3,500, but the round numbers do tend to matter to the market and the mega caps, with the outsized influence susceptible to rising rates. Just a year ago, we saw Apple, Amazon, Microsoft, Alphabet, Meta, Facebook, whatever, moved into correction territory as the 10-year rose 30 basis points to 1.5% in a single month. So over the past month, the same yield is up nearly 70 bips. So that's something to keep in mind. In terms of today's trading action, it's Friday, right? It is OPEX. Could be Lotto Friday, right? I would really caution traders, especially when trading options on a day like today. There could be some very low movement, right? There could be very low moves generally in the market on a Friday today. Yesterday we had to wait quite some time before we got the move that we were waiting for. Pretty solid move into the end of the day, but realistically it was fairly slow. So be very patient right now. We're pulling back that massive rally. I think it was just a news pop that gets resold off. Realistically, if I take a look at the futures here, why don't I take a look at some of these futures and give you guys some insight here. We have this massive level that sits in and around. Let's see. We have a massive level that sits in and around this 36.84, 82 region, where we failed a few times just now, and now we're dropping a little lower. We have another level at 36.70-ish. The main level that I'm going to be watching is going to be 36. 82, 84, because that opens up the distribution back up. There's a thick distribution block above that level that can take us a lot higher, back into the 3700 area, 3702, and even a bit higher into 3714, 16. So that's above that area. Price is going to really try to accept above that distribution. So as long as we continue to fail through that area, I think we can get a slip back down that pushes us a little lower. But for that to happen, we do have to get under 3660. That's going to be an area that we have to watch very carefully. And then naturally the 36 like 45 region or so. Keep that in mind. But of course, the downside distribution target on the larger distribution scale is going to be 35.84. So keep that in mind as the price opens up this morning. We had a pretty strong rally here, probably news based. We'll see if the bulls can try to take it, but just keep in mind 36.84 to 85. Well, 36.85 down to like 80. I know it's a 5-point area, but see what happens within that range. That's going to be a pivotal area for prices today. So with that, happy Friday. Come check us out, community.tradeproacademy.com. And I hope everyone has a slower trading day today. Don't trade as much and enjoy the weekend. So I think lengthier update than normal. I was looking at a few things, and I hope everyone enjoys their weekend, and we'll see you guys on Monday. Take care and goodbye.